welcome to Masters of Real Estate. My name is Mathew Owens, a California licensed CPA and full-time real estate investor. And there are some scary things going on in the economy, and we could actually be in a recession right now. And so, you'll have to stick around to the end to find out the secret truth about what actually happens to real estate during a recessionary climate, during an actual recession. So, there's a lot of underlying fundamentals about the overall economy that are a little bit scary right now that could significantly increase the risk of the overall market or the real estate market and the overall economy combined. So some things to really, look at that have occurred recently to be paying attention to, because these could be potential black swans that could come up and change everything, right? So obviously we've seen major interest rate increases over the last year and a half or so, and which have significantly disrupted a lot of different industries, and of course put more inflationary pressure on the US debt. In addition to that, we have the biggest amount of commercial loans coming due over the next 3 years that we've seen in a long time. And so with that refinancing that needs to occur over the next few years, the interest rates have risen. And so a lot of times the refinances are not penciling. There's major capital calls for multifamily and commercial and retail debt and office space that are very difficult to come up with that money from additional investors, where the refinance loans are going to need to be at a lower price point than what they are right now, even with different value adds, meaning more capital to the table to then refinance that debt at a time when a lot of lending left the actual overall market on the commercial lending side. A lot of banks are having distress right now. We're seeing a lot of bank failures, and there's probably a lot more to come, which is really scary because it could mean a liquidity crunch, a liquidity crisis right at the time when a lot of these commercial loans are coming due. And, of course, people are needing to refinance at higher interest rates and, causing more distress on the overall market as a whole, right? All this while the Treasury is now getting less and less demand for their bonds from international buyers. That demand is getting less and less, meaning they're going to have more inflationary pressure to be able to buy those bonds internally, and it could be a giant disaster. Now, this could happen long term. This could be more shorter term. It could be exponential. There's going to be a breaking point at some point when the international market doesn't want to buy the U.S. bonds. We've seen major rating decreases by the big rating companies for U.S. debt as well, all decreasing. It's not, high quality paper anymore when it comes to buying U.S. debt, and the risk of default has never been higher, of course. With the amount of rampant spending that's happening, it's really scary. And on top of that, you have AI coming into the picture that could potentially disrupt the employment market, which right now the unemployment is at an all-time low. We're seeing very strong fundamentals there. Now, keep in mind, that is the reported figures, not what reality is, right? Like they go in and say, hey, we've had high job growth, we've had record employment, but they are also counting part-time jobs as full-time jobs in those employment figures. There's a lot of maneuvering with those figures to make things look better than they really are. We also have an election coming up, of course, that things may look peachier over the next year, and then we may see a crash occur after the election occurs, which is usually what we see as a strong economy leading up to the election, so that way the political parties look good and they can tout that they're doing amazing and they've gotten inflation under control and all this stuff. But the real numbers are telling a different story, of course. And of course, the unfortunate prospect of a potential World War III, which is a scary situation, could cause major additional inflation, potentially even a hyperinflationary environment, which is a long shot, but definitely a risk to be paying attention to mitigate that and protect yourself for your basic essentials for some of these major changes that could cause liquidity crises, could cause massive inflation, could cause a lot of disruption in the overall market, the overall supply chains and things like that. So get prepared on a personal level and then get prepared on a investment level too. So making sure you have proper food, you have water supplies, you have the right necessities to survive a storm that could occur here in the US or internationally as well that could affect the US. So something to be really, really careful of down the line. So here are now some of the strategies that I'm personally using to mitigate the risk of a market decline in my overall investment strategy to protect myself, and some of the things that you can use as well to help you mitigate and navigate this kind of volatile market that we're seeing, right? So one, first, buy assets that where there's major value add potential in place, right? You're going to force appreciation. You're going to invest in deals where you're going to add value to that deal and have lots of equity cushion. So if the market goes down by 10% or 20%, if that occurs, then you are in a great place still, even if you have a reduction in values. You're still going to be able to sell that asset, get all your money back, and still make a profit on those deals. So meaning you want to be into that asset for less than 80% of what it's worth in case there's a 20% correction in the market. Or if you think there's going to be a 10% correction, which is already a massive crash if that occurs. The only time I've seen it actually crash by 20% is in 2008, of course, when that happened and there was a major liquidity crisis that occurred there. So something to be very careful about is making sure you have enough built-in equity in the deals that you invest in so that that way you can protect yourself from that downside risk, right? Now, another thing that I'm doing is making sure that I buy cash flowing assets. So, and enough cash flow to where if rates went up again, or if you had a decline in rental revenue or an increase in your expenses, insurance costs, property taxes, repair costs, if all and labor costs, if those things went up, you had a 20% decline in rents and interest rates went up, are you break even? Are you making a little bit of money still on your money? Are you making good money on your money still, or enough to outpace inflation? So making sure that you have enough cash flow to withstand that storm is very important. I'm even investing in deals with no debt at all. And I would say that's the next thing that you should really focus on is limiting your debt. Yes. Do you want to take advantage of debt during an inflationary market? Absolutely. But limit that debt. Make sure that you are still in a very comfortable position so that that way, if the market does go down, you are still in a good cash flow position. You're not losing the asset. You're able to refinance when you need to refinance. So be conservative on your leverage ratios in a potential market, turn. So being very careful on that is absolutely key. Okay. So be ready for if interest rates drop again, that you can take advantage. That means trying to avoid prepayment penalties if possible on your debt to be able to refinance as fast as you can and take advantage of that lower debt, to make sure that if rates do decline, you can jump in, refinance, take advantage of that as much as you can. And I would even be trying to get as long-term debt as you possibly can get to minimize the risk of an interest rate increase in the long term or in the short term as well. Okay, so very, very important. Investing in the right strategies also. So I buy properties subject to the existing financing and take advantage of low interest rate type environments. Doing those heavy value add that have major upside potential, dealing with deals, if you're a fix and flipper, for example, that have better margins. So if the rates do go up, if prices decline, affordability gets hurt, you have less buyer demand, you're still in a good place to resell that asset and still make a good margin. And you want to be setting your pricing on your sales just below those pending comps. So, and being very careful to put less weight to previous and older comps and more weight to pending comps that you see out there. So you see what's actually happening in the overall market. I also diversify into some hard assets as well as some shorter term, more liquid assets like promissory notes that I can cash in, get some additional cash flow coming in there so that way, if a deal does come up, I'm highly liquid and can go take advantage of that. And you should have extra powder on deck for being able to pounce on assets, being able to take advantage of assets that come in that are good deals that you can grab because there's distress out there or some issues that come up during a potential downturn of the market. And by hard assets, yes, I do mean real estate, but I also mean gold, silver, commodities, other cash flowing businesses that you can invest in that are, separated from each other. They're diversified into different asset classes, different markets of the country, and different operators, different strategies to counterbalance your risk of any one asset class taking a hit and any one market taking a hit, because every market is independent of each other when you're investing in real estate. So, and like I said, having that extra powder on deck will make you millions of dollars if you're able to take advantage at the right time and be able to jump when you need to. So now let's talk about the truth behind what actually happens to real estate during recessionary markets. Okay, so out of the last 6 recessions, 4 of those recessions, we'd actually have had an increase in property values. Now that seems crazy, right? You might have unemployment taking a hit during that time. You might have distress, less demand during that time in real estate as in general, but you have some other factors that could be making changes there, like interest rates, like government subsidies that come out and government spending to help with those markets. And so what happens is, like during the 1980s, in 1980, when we saw a recession, real estate actually went up by 6.1%. And you saw a interest rate decline by 4.25%, which may have spewed that additional growth in the overall real estate market. 1981, 3.5% increase with a 2.25% drop in rate, of course. In 1991, we had a 1.9% decrease with about a 2.25% rate drop as well. In 2021, we had a 6.6% increase with about a 0.63% drop. 2008 was the biggest crash we've ever seen, which it declined by 19.7%, even though the rate dropped by about 1.13% during that period of time. And that was primarily due to a major liquidity crisis, really bad rampant loans, which we don't have right now, of course. So something to pay attention to during that outlier in 2008. We may have an outlier in 2024, 2025 too, where there's a major crash that occurs from one of those major segments that I mentioned to you. And of course, in 2020, we had a 6% increase and a 1% rate drop. We also had some major government stimulus that came out to push the market forward, of course, and add dollars to people's bank accounts. They shut down the economy. People were at home buying homes. So you can see that a lot of these changes in the market come from depending on what the government is actually going to do, right? So that government stimulus. Now, right now, we're seeing no supply in the market. That's keeping everything strong, even though affordability is very low, very difficult to qualify. So you have a reduction in demand, but also no supply, because when they increase rates, they locked in people where you have 85% of the housing market at below a 5% interest rate. So you stopped people from selling houses, right? So the underlying loan fundamentals are much better, especially in comparison to 2000 to 2007, when people were just refinancing. They weren't qualifying correctly on the loans as far as affordability, as far as qualifying the properties to make sure they cash flow and things like that on rental properties. And the homeowner loans were, much easier to do these option arms and really more dangerous loans out there, right? So the underlying employment is strong in the overall market, and we've had extremely low foreclosure rates, where a vast majority of the people in the market have significant equity that can withstand a downturn in the market. So unless there's major supply somehow that comes up, like in 2008, when there was a major amount of foreclosures that come on the market, I personally don't see how the real estate market crashes. Okay. You may have it actually losing purchasing power, as it may not go up at the same pace as inflation in the future, which is important to have cheap debt in place to counterbalance that, to be able to, decimate that debt during inflation. But until there's a major supply chain change in the market, it's going to be difficult for housing prices to crash. Now, one of these black swan events could occur to, of course, make that happen. There could be another liquidity crunch. There could be any number of things that happen: bank failures, lack of government intervention in the housing market. If they don't lower rates, if they don't step in, if there's a correction that occurs, then those types of things, you might have some increase in distress, which would then cause a housing crash because of the amount of inventory that comes on. So I hope this gave you a little bit of clarity, some things you can do to actually actively mitigate risk in your own investing portfolio and understand what actually occurs to real estate during a recessionary climate. I hope this helps and adds value for you. And good luck and happy investing. Do you want to learn how to create financial freedom in your life through real estate and take your investing business to the next level? If so, you can follow us in one of the following ways. First, you can take one of our free webinars on how to analyze property, how to raise capital for real estate, and how to market and find deals. 3 of the key pillars to becoming a successful real estate investor. Number 2, you can join us on our mailing list, where you'll get tips and tricks on real estate investing directly to your inbox. And number 3, you can take our 6-month real estate course that teaches you every aspect of real estate investing you can think of, and more importantly, create financial freedom in your life through real estate investing strategies that I teach. If you want a master's in real estate in 6 months, this course is for you. We're going to go over how to raise money, promissory notes, syndications, fixing and flipping, buy and hold investing, tax and legal structures, self-directed retirement accounts, financial education, how to run a business, how to market and find your deals, and most importantly, how to create that financial freedom in your life so that you can stop trading your time for money and create passive real estate cash flow that you can live off of. If you're interested, go ahead and click on one of the links below, and I look forward to seeing you guys on the other side.